Okay, so something pretty big just went down in the U.S. regional banking world, a real shockwave. And honestly, it's bringing back some pretty scary memories of past crises. So let's get right into it and figure out what's really going on.
So picture this. It's October 16th, 2025. You're watching the market and suddenly a major regional bank, Zions Bank Corporation, just plummets. 12% in a single day. You know, a drop like that, that's not just a bad day at the office. Something is seriously wrong.
Yeah, a drop like that sends tremors through the market, right? People immediately started whispering, is this 2023 all over again? So what did happen? Let's peel back the layers and get to the real story behind that scary number.
Okay, so let's dig into the plunge. It all kicked off with an announcement that, well, it pretty much blindsided investors. And the market's reaction? It was fast and it was brutal.
So Zions comes out and says they've got a $50 million loan loss because a borrower basically lied to them. Ouch! But here's where it gets really interesting. At almost the same time, another bank, Western Alliance, says, hey, we've got a problem with that exact same borrower. And boom, their stock drops 11%. You see, this isn't just one bank's bad luck. This is two banks, one bad loan. That's a red flag.
And the damage didn't stop there. Look at this. It wasn't just Zions and Western Alliance getting hammered. The entire regional banking sector, which we can track with this thing called the CRE ETF, took its worst hit since April. The fear was spreading like wildfire. This was real contagion.
But believe it or not, this one bad borrower, they're just a symptom of a much, much bigger problem. The real cause is something that's been hiding in plain sight for a while now.
Get ready for this number, $1 trillion. That's a jaw-dropping amount of commercial real estate loans, you'll hear it called CRE, that are all coming due by the end of 2025. Think about that. It's this massive wall of debt that somebody has to pay back, and soon.
So why is that such a huge deal? Well, think about it. After the pandemic, so many of us started working from home, right? That means office buildings are sitting empty. If there are no tenants, there's no rent, and if landlords aren't collecting rent, guess what? They can't pay back those giant loans. The delinquency rate on these loans has skyrocketed to over 10%. This, right here, is the ticking time bomb.
And that bomb isn't just sitting in a corner somewhere. According to one analysis, there are 59 large U.S. banks that are in a really dangerous spot. Their exposure to these risky CRE loans is over 300% of their core capital. Now, core capital is just a fancy way of saying it's their safety net, their cushion against big losses. Having that much risk compared to your safety net, that is playing with fire.
So naturally, when you've got a situation this tense, the experts are totally divided. Is this a big deal or not? There are basically two schools of thought on where this is all heading. So what do you think? On one hand, you have people saying, hey, relax. This is just an isolated incident, one bad borrower. But on the other hand, you've got people sounding the alarm, warning that this is the first crack in the dam, a sign of a massive, systemic crisis about to unfold. Is it just one problem, or is it the tip of a very dangerous iceberg? And you know who's on the tip of the iceberg side? Jamie Dimon, the CEO of JP Morgan. He has this famous saying, if you see one cockroach, there are probably more. He actually said that back in September, way before this Zions thing blew up. And it just perfectly captures the fear that this is not just one cockroach.
To really get why people are so scared, we have to pull back the curtain on something the banks are doing. It's a strategy that, on the surface, seems helpful, but it might just be hiding how big this problem really is.
They call it extend and pretend. It's exactly what it sounds like. So instead of a bank saying, okay, you can't pay, you're in default, we're taking a loss, they say, you know what, we'll just extend your loan, we'll change the rules a bit. They're pretending everything is fine. It's the ultimate financial version of kicking the can down the road and just praying the problem magically solves itself.
And that brings us right back to Western Alliance, one of the banks we started with. Remember them? Well, it turns out they're getting hit from two sides. They have that shared bad loan with Zions, and they're also exposed to a totally separate bankruptcy with a company called First Brands. It just goes to show you how tangled up all this risk is. You pull on one thread and you have no idea what else might unravel.
Okay, so we've got this sudden stock drop, this trillion-dollar commercial real estate bomb, and banks playing extend and pretend. So, where does that leave us? What's the bottom line here?
Well, the truth is, we're in this really precarious middle ground. This is not 2008. It's not a total systemic collapse, at least not yet. The biggest banks seem okay, but
To call this an isolated incident, no way. It's way too connected for that. The whole system is definitely feeling the pressure.
So here's what you really need to remember. That $1 trillion in maturing commercial real estate loans, that's the ticking time bomb. The real test is going to be what happens next. Are we going to see more defaults start popping up, one by one, across those 59 banks that are super exposed? We have to watch that space like a hawk, because what happens there could decide the fate of the whole financial system.
And that leaves us with the one big unsettling question, doesn't it? When is this time bomb finally going to go off? We can all hear the ticking, but nobody knows for sure when the timer hits 0.
And on that note, that's our look at what's happening with regional banks. Thank you so much for watching all the way through.